You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Dan Hanford. Dan is a principal at Hanford Capital, a multifamily real estate investing and syndication firm. Now, Dan is also the founder of the Multifamily Investor Nation with 34 groups and more than 2,000 members across the world. Now, in addition to his real estate endeavors, Dan is also the president and founder of 5 specialty medical clinics throughout South Carolina. And so in today's show, we're going to have a candid conversation with Dan about his entry point into the multifamily syndication space, how he manages his time while running a very busy medical practice, and how he's built an all-star team and much, much more. And so I'm very excited to get onto the show with Dan. But before we do, I have a few housekeeping items I'd like to run through with you guys. First and foremost, I've been mentioning now for the last couple of weeks, we're in acquisition mode here at Sunrise Capital Investors. And so we're looking for mobile home parks, preferably 60 lots or larger across the country. If you guys are out there in your hunt and you're in your search and you run across some what might seem to be opportunities in the mobile home park space and the communities are 60 lots or larger, please think of us. You can reach out to me through my website, kevinbupp.com. Let's go to the Contact Us page, or you can go to our company website, sunrisecapitalinvestors.com. Again, Contact Us page, and we'll respond accordingly. Next up, just want to make a mention that we recently opened up the second tranche in our mobile home park growth and income fund. And so if you're an accredited investor and you're interested in partnering with us on our acquisitions, please visit our secure investment portal by going to invest.sunrisecapitalinvestors.com. And there you'll be able to review our PPM and our overall investment summary. Lastly, guys, if you happen to be in the Tampa Bay area, that's where we're based. We're over in Safety Harbor, which is about 20 minutes across the bay from Tampa Bay International Airport. Come and visit us. I'd love to buy you a drink or buy you lunch, buy you a coffee, whatever you might have time for. Just, again, reach out to me through my website, kevinbupp.com, the Contact Us page, and let me know when you're coming into town. Let's see if we can coordinate our efforts together.
All right, guys, now without further ado, I'd like to welcome our guest for today's show, Dan Hanford. Dan, how you doing today, my friend?
Doing pretty good, Kevin. How about yourself?
Oh, doing fantastic, man. No complaints. Nice and sunny down here in Florida today. So don't know where you're based out of. So why don't you tell us, geographically speaking, where you're located and a little bit about your background if you could.
Sure. I'm in the Carolinas. So I'm here in Columbia, South Carolina.
Okay.
And kind of got started in the multifamily space after starting 5 medical offices and, having some cash flow being spun off of those and needing to stop writing 6-figure checks to the government. And so I decided to, start to go into the multifamily space full time from that.
You look a little too young to be a guy that has opened 5 medical offices over his lifetime. You're like in your 30s. So like you've been hustling for a long time.
Yeah. So I started the offices as I'm a licensed chiropractor myself and started it in 2011, my first chiropractic office, and then decided that about 2 or 3 years in that I wanted to start, bringing on and hiring on a medical team to help with some of the ancillary things we were wanting to do in the office that we couldn't do because of our licensure restrictions. And so started hiring on MDs, nurse practitioners, and then decided that we wanted to go from 1 clinic to 5 clinics. And so I put a goal and a plan in place to grow from that 1 to 5 in a 24-month period of time, and ended up doing it in 18 months.
Wow.
So now we're here in Columbia, South Carolina. We have one in Greenville, Charleston, Fort Mill, which is that South Charlotte market, as well as North Augusta. Mm-hmm. And so we just have decided to, expand pretty quickly. So, I'm actually 36. I just turned 36. So I like to say I retired by 35 and then got bored to death for about 2 weeks and decided to do the multifamily stuff full time.
All right. Fantastic. Well, let's talk about the multifamily space. Let's talk about that transition. You got bored, right? So you're making money in your medical practice. Things were going great, but you had too much free time on your hands, right? And so you started searching. And tell us a little bit about what that real estate search looked like for you. Did you ultimately know, like just right out of the gate, that multifamily was kind of it based on what you had read or podcasts you had listened to, or did you kind of go through a tasting of each different property type before you ultimately landed on multifamily?
Yeah, so I'll kind of give a little bit of a detail there. So I had been researching multifamily for probably about 1.5 to 2 years prior to making that decision, but I never really had the time to focus on it because I was so, in the business and the practice all the time. And so I was doing a lot of the day-to-day stuff, putting fires out, going to meetings, things like that. And then I went to an event in February of 2018 that really made me transform my thoughts and my mindset of where I should be. And I felt like, it was actually, I'm not sure if you know of a guy by the name of Ty Lopez, but he's kind of in the internet marketing space, various things like that. But I had never heard of him before, but he spoke at this event. And it just, something that he talked about that really hit me was about how to become the general in your business. And of course, I was the president and the CEO at the time. And I'm thinking, well, of course, I'm the general, I'm the president, I'm the CEO, I'm running this ship. And so, I had sat back after hearing the rest of what he spoke about, and he's like, but if you are tied to it and you're doing all the day-to-day stuff and you're having to go in, he goes, that's not really being the general. He said, look at Warren Buffett. That's the true general, right? So he doesn't have to leave his house at any time. He's basically on phone calls, checking in with the CEOs all the time, trying to check on them, kind of see how things are running. But he's not running those businesses day to day. Like he's not in there working with patients or customers or clients or whatever, or employees or anything. He's completely removed. And so I looked at my current setup, and this was actually on a Friday night that I thought about this. And then by 2:00 in the morning on Saturday, that's basically that same night, I had decided that I was going to step out from the practice and promote my COO at the time to the CEO so I can step away. So I still own the practices 100%. And I just basically took away the CEO role and gave it to somebody else. And I did that Monday morning. And then Tuesday, I announced it to my staff, and I haven't stepped foot in the practices for the last year. And they've continued to go and to grow. And we're opening probably 2 more clinics this year in Myrtle Beach and Hilton Head, and I'm not even going to be there for it.
Yeah. So isn't that amazing? It's funny when you start a business, you start a company, you feel like literally you're at the helm, but you feel like if you step away, that the folks that are there, things are going to fall apart, things are going to crumble, and probably what you've realized. That was the hardest
thing for me.
Yeah, but when you stepped away, you went away for a little while. You probably still kept a finger on it, a couple fingers on it, and then you slowly removed fingers one at a time. And you probably realized that you probably even had a much faster growth trajectory, empowering the folks that are there, the brains that are there, the power that's there. You probably had a little bit stronger growth trajectory than what you might have had with you being in there yourself. Do you feel that way? Because I feel that way when I go away for like a week or two. I feel like, not that I'm in here micromanaging everybody, but I feel like, everyone wants to do their best. I mean, if you hire the right team, you bring the right staff, folks that align with your core values of your company. I feel like they come in with the mindset of they want to do the best. They have the best intentions. They want to grow. They want to grow with the company. And when you step away, it gives them the ability and the freedom to do so. That's kind of how I feel.
Yeah. I think that one of the things I learned earlier on is that art of delegation. And in the beginning, it was very hard because I'm the type of person that I want to do everything because I know I'm the best person to do it. And I know that might sound a little bit conceited, but it is. And so it's a fault that I have, and I have to realize it, right? And so I, started to delegate things. And in this situation, I completely removed myself, except for one thing. So I didn't want to just like you talk about like slowly getting things away. No, like Monday morning, I told the COO, I'm like, I want you to be the CEO. I'm out. And then Tuesday morning, I literally was like, all right, I'm out. It took me like a week to like, all right, here's the password for this thing and this thing and this thing. And here's how to do this and here's how to do that. And then I was gone. But what I did do is I made sure that every Monday morning, because I'm a big believer that if you can't measure something, then it's very hard to manage it. Mm-hmm. And so I have very strict criteria on different statistics and numbers that I want to see across my desk every single week. And so every Monday morning, I get what I call my financial reports, which gives me kind of like an overview picture of how each one of the various clinics are doing and then the organization as a whole. And so I look at those every Monday morning. I get those from our staff accountant, but I also get those from our billing department. And I also get some of those numbers from our marketing department that tells us, how the marketing is doing, how many new patients we got, how many conversions we got, all that kind of stuff. And then once a month, I meet with all my corporate team I have an outside office outside of the clinics that I do what I'm doing right now. And we meet once a month to go over anything else and to make sure that my vision is continuing to go forward, even though I'm not there.
Yeah, fantastic. So let's talk about the multifamily space. Let's talk about your entry point into it. What did that look like? I mean, ultimately, maybe the first deal is where we start. You made the decision to get into multifamily. What did that very first investment look like in the space?
Sure. So one of the things that I did when I first made the decision is, well, first I retired basically for like 2 weeks. And that's when I got bored is when I retired. Yeah. And so my wife was like, you got to get out of the house. You're just driving me nuts. And I was driving myself nuts. And I was just bored to tears. And so I just started going to lunch with everybody, kind of talking to people and saying, hey, how can I add value to you? What can I do for you? And then sat down with one of my bankers in Greenville, South Carolina. And she said, well, I know you've always been, the last year and a half, you've been doing a lot of research on, multifamily real estate and stuff like that. And I'm like, that's what I need to do. And so I just didn't think about it at the time. And so from there, I started, going to seminars and reaching out to people. And I already been reading a lot of books. So I had a lot of the head knowledge as it was. But then I started to try to look for a mentor to be able to help me in the space because I had already accomplished a lot up to this point in my life. And I didn't want to start small when it came to anything else. Yeah. And so I didn't want to start small with real estate and start with single family or anything like that or duplexes. I wanted to go big. So I immediately made a goal of, I don't want to buy anything less than 100 units or less than $10 million in purchase price. Mm-hmm. And so in order for me to do that and reduce the learning curve, but also any mistakes that I might have, I hired my first mentor and the person I wanted to hire was somebody that I already knew was where I wanted to be. And I knew that I was going to have to write a big check to be able to get this person, which was fine with me. But I also, in writing that big check, wanted to make sure that I was getting that person and not a coach of that person. I wanted to have access to that person. So that's what I did. I wrote a check, got my mentor, and he's with me all the way through this point. And one of the things that I did first when I went into the space is I didn't go out first and just try to find my own deal. I was trying to find my own deals, but underwriting and analyzing and touring properties and all that kind of stuff and going through the motions. Mm-hmm. But I didn't just immediately go right into buying my first property by myself. So what I did was I helped and partnered with another group that actually allowed me to help raise money for them and be part of the general partnership and contribute in a certain way that allowed me to be able to get some of that experience and exposure. I did that first for my first 4 deals. Okay. And that way I could, one, build my portfolio up as well so that when I go and talk to brokers and sellers, they see that I'm actually active in the space, I'm closing deals, I'm taking action. Mm-hmm. And then when we did our first deal, the deal that we did very first was one that we actually got on a rebound off of an LOI that we had lost originally. Then 4 weeks later, the broker calls us back and says, the deal is back on the table. The first buyer couldn't get it done. Do you still want it? And we're like, absolutely, And so we were able to take that one down. That was a 130 unit deal. That was our first property.
Okay, fantastic. Let's talk about that for a second. I think that's an important point. A lot of folks, they get very discouraged when they make offers and they ultimately get beat out by someone else, another buyer. But I think follow-up is the key. And it sounds like that broker follow up with you, but in a lot of instances, staying in touch with that broker, finding out when that go hard date is for that earnest money of the person that beat you out on that opportunity, setting that on your calendar and making it a point to follow up with that broker, maybe even before that hard money date, because ultimately these things can kind of fall apart before that point in time. If it's an honest buyer and they realize that they're not going to be able to do the deal, hopefully then they pull out before just letting it drag up to the actual go hard point. But have you found that to be the case in any of the other transactions that you participated in, that you got basically beat out in the beginning and the deal came back full cycle and you guys ultimately bought it? Has that ever occurred?
Yeah, I mean, that's basically kind of what this one did. But okay. I mean, most of the ones that I'm seeing that are coming back are actually between the LOI and PSA phase. So they've signed the LOI, they've committed to buy the property, and then for some reason, the contract negotiations, something falls through and they can't get it done. And so they come back to us and they say, hey, they just couldn't get it done. They were a little bit wishy-washy there and stuff like that. And sometimes we can do the deal at that point, but sometimes we've kind of moved our capital somewhere else. And so we can't do it. Mm-hmm. But in most situations, I'm fine to get a deal on a rebound because number one, it tells me that I'm strict on my criteria, on my underwriting. I know where my strike price is, and I'm very diligent in saying, all right, this is the most I can pay, and the numbers still work and not just overinflated. Like we just had one recently that we were bidding on. It was the $18.9 million project and we got outbid. We were the second highest bidder, but we got the highest bidder that was outbid us bid $500,000 more than we did. And we can't figure out how it works as far as an underwriting standpoint. But obviously, people, when we say that, it's everybody's criteria are different, right?
Sure.
If you're dealing with a fund that only cares about a 10% IRR and we're trying to get a 15 or 16% IRR right now, it's hard to compete with that, right?
Yep.
So it really just depends on what your goals are and what you're trying to find in these properties. But I'm perfectly fine to get them on a rebound because it means I know for sure I didn't overpay on the property because somebody else tried to overpay and they couldn't get it done, and now it's coming back to me.
Yep.
But we're definitely out there and we're submitting LOIs and we're confident on the deals that we submit on. So we don't just put a bunch of blanket LOIs out there. We only submit on ones that we really know we want to get. And we even secure them with some hard money day one when we first get the deal locked up too.
Wow. So in the multifamily space, that's pretty much in order to be competitive, you guys are putting hard money from day one, correct? Is that what you stated?
Yeah. Right now, the hard money day one is what's getting the deal done in most circumstances. So I still believe, and I'll give you an example, that price can still outwin hard money day one.
Yeah.
And that's exactly what happened on that last deal I was just telling you about. So we did $18.9 million with $200,000 hard day one when we signed the PSA. And they did $19.4 million, no hard money at all. And the seller went with them instead of us.
Wow. Huh. Very interesting. Talk to me about the due diligence, the preliminary due diligence that takes place prior to you feeling comfortable with putting hard money down right out of the gate.
Mm-hmm. So one, we would only do that in a market that we are very comfortable with. So, and I say we because I now have two other partners that are with me. Mm-hmm. I have a gentleman by the name of Danny Randazzo, who's a financial analyst. And I also have Brandon Abbott, who is our acquisitions lead and does a lot of the boots on the ground and due diligence. So before we even put an LOI on a property, Brandon actually goes to the property and is on site. So he's going to the property, he's doing the property tours, he's taking pictures, and his background is in property and casualty. And so he actually throws up a drone into the air. He does 3D modeling of the building. He does satellite imagery of the roofs. He also does measurements of the roofs to see, if we have to replace the roofs, what's going to cost us, what's the condition of the roofs. And so the 3D modeling of the building is very helpful because the software he uses is called Xactimate, and it's a property and casualty software. But if we need to, estimate how much it's going to cost us to, rebrick a building or not just paint a building or whatever, you can plug in the dimensions from the 3D modeling and it spits out an exact quote.
That's awesome.
Using labor rates in that particular zip code. And so it's very proprietary. It's a very unique software that's very, that's not usually used in this space, but it actually has been very effective to use it in this space because of that.
It sounds like it should be.
Absolutely. So, that's one piece of the due diligence, but, we also will comp the property if we don't already have those numbers. So when we're in markets that we're familiar with, a lot of times we're familiar with what the market rates are going to go for rentals in that market. And so we do market rental comps ourselves. So we don't just look at CoStar or some of the other, I think Axiomatrix is another one that you can actually get some of those comp numbers from. We actually go to the property, and then as we're going to the property, we'll actually shop the properties around it to see what are some of the interior upgrades that are happening on some of their renovated units, what kind of rents are they achieving on those properties, and hey, what can we do that on this property here? And there are many times I would say probably more times than not that the property just doesn't make sense because the rent comps are maybe already pushed to the max of what that market could do. And we recently had an off-market deal come to us, and we're all excited because it's off-market and stuff. And we start running the numbers, and the seller said, "Well, if you want it off-market, I want at least to have a 12 in it, 12 million plus." And we underwrote it at 12 million, and the IRR came in at like sub 13, and we're like, that just doesn't work for us. We need to get higher than that. And so we opted, because there's other deals out there, we opted to let that one go because we wanted to be able to go find another deal that's really good for our investors. Got it.
And what markets are you guys focusing in today?
So right now, our primary focus has been in the Carolinas. So Charlotte, Raleigh, Charleston, Greenville. And then as we're growing, we're expanding into other markets like Orlando, Jacksonville, and Atlanta. And then we also have some of our properties in the Houston market as well. Or not the Houston, but the Texas markets. Houston is one of them, but we also are in Dallas, Fort Worth as well.
Got it. What were some of the biggest challenges like stepping into your very first deal? I mean, I know that you didn't do the very first deal yourself in terms of like going out and finding it. Like you partnered with a pre-existing team, someone that had a track record and helped them raise capital on the GP side. But I mean, just generally speaking, what were some of the biggest challenges that you faced just getting into the space and finding a place?
Yeah. I would say that the biggest challenge was when talking to investors, them going, well, you're new to this, right? And that's one of the reasons why I wanted to kind of align myself with another operator that I knew had a track record. And I can say, yes, I am new into this space, but let me tell you about the operator. And then I could basically just divert that to the operator. And then that got easier and easier as I started to do more deals, because now some of my investors are in multiple ones of our deals because they're now seeing me in multiple spaces. So now when I come out with another deal, they're not saying, what's your experience level? I've already had conversations with them about that. They already know my experience level. But at the same time, I look at the syndication space and go, if you have a background in business and you can actually manage large budgets, it's a pretty easy transition, because that's really what we're buying when we're buying a syndication. That's basically what you're buying when you're buying a mobile home park. You're buying a business, like you're buying income, and you're getting, and you have expenses off of that. So you're buying a business. And even though that business is, secured with an actual asset, you're still buying a business.
Yep.
So if you have experience managing large budgets, which, I have experience managing a $10 million plus budget with my clinics. So when somebody comes along and they, we have a property that has $1 million budget on it, that's not that hard for me. And actually, one of the things what we're finding with some of our properties is that not only are we able to increase the income by increasing the rental income and adding some additional amenities that allow us to increase and push that NOI, we're also able to start to run the property more efficiently by reducing expenses in certain areas, because I also have a background in kind of IT space. So I've been able to go in and actually look at a property and go, oh, we don't need that. We don't need that. We can replace that with this type of technology. We can reduce the staff because of X, Y, and Z, and utilizing the technology that's already available that they're just not using.
Got it. No, very interesting. Let's talk about some of those ancillary income streams, the ones that you find to be the most common that you can add to a new acquisition to generate additional revenue. What are some of the big ones? Like if you decide like a top maybe 3 or 5 that you see in that space, in the multifamily space.
Sure. So I will mention 3 of them. One of them is actually not necessarily increasing income, but it's reducing expenses, which is always good, right?
Yeah.
So first one I would say is valet trash. You've probably heard of that before, but basically we have an outside company that we contract with, and they come in, every day and take trash off the property and put it into the dumpster or whatever. And we charge that to the tenants, and then the tenants are able to not have to worry about doing all that. We don't have to worry about hoarding or anything like that. We still have to worry about hoarding some properties, but you don't have to worry about just trash building up and nobody taking it to the dumpster. So that's one thing. We typically get charged about $10 to $12 per unit for that. And then we offset that by charging the resident $20 to $25 a month on top of their existing lease for that. And so we haven't had a lot of pushback with it. Every once in a while you get a little bit, but usually the way those companies work is they roll it out as the rent roll turns over. And so you're not just all of a sudden day one charging people, because you can't, because it's not built into their lease. But as the renewals come up, they will start to collect that additional revenue.
Is that voluntary or involuntary for the tenants?
It's involuntary, so they're required to have it.
Yeah, interesting.
Yeah. So it's one of those things that it's also allowed us to reduce the expenses at the same time, because instead of having to have 5 dumpsters all across the property spread out, you can have 2 dumpsters in one location in the back and just increase the pickup frequency.
Yeah, very interesting. Okay, so that's great. I love that.
Yeah, so that's one. The second one I would say is what was the second one? Well, hopefully that one will come to my mind. But the third one is as far as reducing expenses is really all about trying to look at some of the technology that's there and that's not being utilized. So for example, on the first property we purchased, the 130 unit one, they were using a system called Yardi Matrix or Yardi Voyager, if you will. And it's property management software, probably one of the most popular ones and the most robust ones out there. And I didn't know for sure if we were going to like it or not, but I actually do like it. But the reason why I can say we were reducing expenses is because we were able to reduce some of the personnel on the property because of the inefficiencies that were happening with the maintenance requests. Okay. And so this is really just kind of one component that Yardi can help with, but they already had the system in place for it. But what they were doing is that they never trained the new residents on how to use the app that came with it, the actual Rent Cafe resident app. They didn't teach them how to use the website to actually submit tickets. They didn't train them how to use the email. And so we'd be sitting there in the office, and they'd get phone calls throughout the day. And I'm like, oh, was that like a prospective resident? Oh, no, it was a maintenance request. And I'm like, why are we handling those over the phone? Like people should be trained to use the technology. And so she goes, I said, well, she said, they're never trained. And I'm like, well, we got to put system in place for that. And I said, well, how do those tickets work? And she said, well, resident calls in, I have a maintenance request. They take it over the phone. They type into the Yardi system. And then sometime throughout the day, the property manager looks and sees, oh, there's maintenance requests in there, and presses a button and prints out all of the maintenance requests, takes them to a separate room and puts them in a bin that says to be completed. Yeah. And then you can kind of see where this is going. And so sometime throughout the day, the maintenance guy, it comes out of his maintenance shed, walks across the property to the maintenance, to the leasing office, goes into this separate room. Oh, I have maintenance requests. Pulls them out, goes back to his maintenance shed, gets the tools he needs, goes to the actual residence unit, fixes the request. He has a duplicate copy. So he's like writing on one copy about what happened, and to the resident on the other copy, he's doing the same thing for bringing it back to the property manager. And so he fixes it, leaves one behind, goes back to his maintenance office, puts his tools down, goes back to the leasing office, drops it off in another bin that says completed work orders or whatever. And then sometime throughout the day, the property manager goes and looks at that bin in the separate office, pulls them out, goes to her desk, types them all up for him.
Oh my gosh.
And then they close them out. And I'm like, that is just like the most inefficient system possible. Now, obviously like 10, 15, 20 years ago, that was probably the thing, right? Like that was like a cool system. Hey, look what we did. We put this procedure in place that saved a lot of time and headache. But nowadays, they already have software that's built in. And we were like, have you guys ever tried to use the app? There's actually a maintenance app that's specific to this. Like whenever he gets a request come in, it goes bing, and it tells him you have a maintenance request. And he can be sitting there smoking a cigarette in his maintenance shed and getting a bing. And now you can just grab his tools and just go straight over there, fix it, and he can now type his notes up while he's in there with the resident. And the resident gets an email saying, hey, your work order has been completed. This is what we did. Here's some pictures of the work that we did. And they can take pictures on the phone and bing it all together. Property manager doesn't have to touch a thing. And so just doing that was able to allow us to be able to reduce, they had a maintenance person plus they had a maintenance supervisor and a maintenance tech on 130 units. Wow. And they weren't getting but like 5 to 8 requests a week. And so we were able to just go in there and put this new system in place and be able to, eliminate one of those staff positions and reduce that into that expense level just from, looking at the technology that wasn't already being utilized.
Yeah, that's amazing. There's a lot of properties out there. I mean, especially in that size range that are run on very antiquated. Well, this wasn't even an antiquated system. This had the technology there. It just wasn't being utilized, right? But either in that scenario or they're running on a very antiquated system to where you can increase the efficiency. So I think there's lots of opportunities out there like that in your space, in our space, and many other spaces as well.
So the second one I just remembered, which is a pretty common one, is the laundry service. So not only just, I'd probably say, 10 or 15 years ago, everybody was looking at this going, hey, let's see if we can add coin laundry, right? Somebody doesn't have coin laundry, let's add it and increase the income. And that's definitely something we would consider and look at. But right now, a lot of the properties already have that if that's an option. Mm-hmm. But what they're not looking at is can we get rid of the coin laundry and go ahead and add washer and dryer hookups in the units and increase the rents because of that? And so we look at it that way as well to try to find that additional value add.
Mm-hmm. Okay, fantastic. How about things like dog parks and barbecue areas and all that kind of stuff? Is that something that you guys are adding as an additional amenity? I know there's not necessarily additional revenue generated from.
Oh, but there can be. There can be.
I guess probably not dog parks, but I mean pet fees. That pet rent, I guess, is probably the better way to put it. That's something that's I feel like maybe not brand new, but it hasn't been around all that long. I mean, 15 years ago, 20 years ago, when I lived in an apartment, it was a normal pet security deposit. And, you paid it one time and you didn't get it back if you turned the unit in and it had pee on the carpet, right? I mean, now the more common scenario is pet rent. Talk about that if you would.
Sure. Yeah. So we've actually had properties that we've taken over that, when we're walking the units, every single one of the units will walk before we acquire the property during that due diligence phase. We actually make sure that when we're walking those units that we know, does this person have a pet? And then we cross-reference that with, are they paying the pet rent fee? 50% of the units a lot of times aren't even paying the fees when they're supposed to have been paying them. And so immediately we can go in there and start saying, all right, well, you would agree to pay the rent fee, but now you have a pet, sometimes 2 or 3, and they haven't even paid any of the pet fees. And so you can go in there and do that. But one of the things I will tell you is that when you look at dog parks, A lot of times you look at those and you go, they're not really revenue generating. Obviously, you could, attract more people that have pets because you have a dog park. So there can be a little bit of an added bump there. But in addition to that, what else do you think you could do in a dog park to increase revenue?
I have no idea.
What about a vending machine that has dog bones in it?
Okay. I like that.
Yeah. So you try to look at a property and things on like from the outside perspective. I mean, it's not going to be like a couple $1,000s a month type thing, but increasing the income of that property by $50, $100 or however much a month can just change how you're doing things, especially if it's a larger property that you have multiple types of those things in there. But even if you have coin laundry, what's another good thing to be able to make sure you have next to a coin laundry?
Yeah, laundry detergent or softener or whatever it might be, right?
Yeah, vending machines that produce the softeners and the whatever, all kinds of stuff that you do with laundry, and you can increase the revenue from that. So it's just looking at properties from a different perspective and a different angle. And again, all of those types of revenues, we're talking about a vending machine and things like that. We don't sit there when we're doing our underwriting on a property and add that income in there. That's all the stuff that's just like added cherry on top.
Icing on the cake. Yep.
Yeah. You just can't underwrite for that.
Did you just make up the dog bone vending machine, or is that a real thing?
I've actually been thinking about that for a while, so I'm pretty sure we'll be doing that pretty soon, but we haven't done it yet.
But is it a real thing? Do they exist?
They do. They do.
Machine.
Yeah. Well, you think about it this way. I got the idea because I was sitting there in Florida looking at a property in Jacksonville, Florida, and it was a lot of the properties in Florida. They have like a little pond in the middle, and they have the properties that are all surrounding it and stuff. And so we were sitting there, and this one had a gazebo that went out into the water. And I was walking out there, and I was seeing all these birds, and they had actually stocked the fish and stuff like that. And I'm like, where's the vending machine to feed the birds
for the corn or whatever? Yeah, whatever.
Like I would definitely have that on that property. And then I was thinking, they also have a dog park. They could do the same thing with a dog park. Like they're missing out on revenue that's easily there. Plus, people that they're feeding those fish, right? Because they got to keep it stocked. So they got to feed it. So instead of you having to pay for the feed, now you are actually but you're allowing your residents to be able to pay and feed the fish for you.
That's awesome. I know. I love it. It's like a theme park. So I think about like the ducks. You can throw them you can pay a quarter and get the corn out, right? Or birdseed, whatever it is. So very interesting. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning to the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. Let's talk about today's market. You're in multiple different areas buying apartment communities, but just generally speaking, from a high level point of view, there's a lot of competition out there today. There's always someone willing to pay a little bit more for a property, right? And so it's a little bit more challenging today than what it might have been 5 years ago to actually take down the type of property that fits your criteria. With that being said, there's still opportunities out there if you dig hard enough. So what excites you the most about where we're at today in this cycle, where you're at in your business, generally speaking? And on the flip side of that, what scares you? What keeps you up at night?
Sure. The first thing I'll say is these kind of go hand in hand because, one of the things I look at is supply and demand. So we talked about buying a business, right? Well, when you talk about buying a business, you have to look at the supply and demand of the product that you're trying to buy or the product that the business is selling. And right now in a syndication model, my customer is my investor, right? My customer is not the resident. Now, it's because I'm trying to, find investors that want to invest in my product, and my product is the multifamily property. Now, in the multifamily property, my customer is the resident. So I have to look at that as well because it's kind of a twofold thing there. So when you look at it from a perspective of supply and demand, if you go to a website called weareapartments.org, they track very closely the supply and demand in various markets. And right now, between now and about 2030, we are going to be in this nation in a shortage. We're going to have a shortage of about 4.6 million apartment units. So when you look at something like that, what does that tell you? That tells you that if we don't start to have increase in new supply coming online, which a lot of markets you look at and you go, man, there's a lot of supply. But you don't understand that that's still not enough. We still need more apartments. And so we know that there's going to be a shortage, what that's going to do is that's going to increase the demand because the supply is going to stay fairly stagnant. And so what that means for us as investors is that when demand starts to outpace the supply, that's when you're able to continue to increase those rents. So even though over the last 5 to 10 years since the crash in 2008, we've seen a very good bump in rents, I project that's going to continue to happen because of the supply and demand issue. Mm-hmm. Now, obviously, it's market specific, so I don't think you can just say all across the board is going to be like that. You look at a place like Philadelphia and you look at theirs on that same website, weareapartments.org, and their supply is actually going to outpace their demand. And so that's going to cause some of the rents to start to drop or level out.
Yep.
Whereas you look at other markets like Atlanta. Atlanta, even though they have a lot of supply going online right now, they are still in a shortage. And you can still see that all the way up until 2030 on that website that there's going to continue to be a shortage. And so what that means for us between now and 2030, unless somebody comes in and starts to build a ton more units, then the supply, because the supply is not there where we need it to, so that demand's going to go up, the rent prices will continue to go up, the values will continue to go up as well. So that's kind of in a nutshell, where I feel as far as where the multifamily space is going. Some people right now feel like we're over, not we, but just in general, that people are overpaying for these multifamily assets. And it's because they've never seen these assets do this well, because they've never seen these kind of assets have this shortage of a supply and this high of a demand. And that's what happens in any type of market when you start to talk about supply and demand.
Mm-hmm. Interesting. Okay. Well, that excites you. How about what keeps you up at night? What scares the crap out of you, Dan?
I would say the biggest,
not literally speaking, but just what scares you? What keeps you awake?
Yeah, I would say that the biggest thing that scares me is the information or the unknown, the data that I don't know. Because I would say that's the case with anything. Even with my medical practices, the thing that keeps me up, which nothing really keeps me up at night, because I practice two things. So I make sure I have a hard day's work and a clear conscience. If I can have a hard day's work and a clear conscience, I can get a good night's sleep. I don't stay up late. The only time I'm staying up late and is when my mind is racing about a new idea or new something that I want to do. But something that would keep me up at night is the unknown, right? Like something that I just don't know what might happen. And so just like with the correction, there's projections of this correction coming up. We've been talking about it. If you look at the dates back until 2015, we've been talking about this, and it hasn't happened yet. And so it's just one of those things where who knows what's going to happen, and it's hard to really predict when it's going to happen. But there's definitely some things that you can do to increase that or decrease that risk of if it does happen. What can you do to hold yourself through and kind of weather a storm, if you will, when it comes to the impending correction or whatever. But same thing within my medical practices, like I was saying earlier, is that one of the things that concerns me the most is we accept insurance, right? Well, I don't know. Maybe one day it's going to happen where the insurance companies are going to say, no more. We don't want you billing anymore for our services, and they cut me off, right? And so, is that a fear? Is that a risk? It is, and but it's not something that I can control. Like I cannot control what happens there. I cannot control what happens to the market in the next few years. But I can tell you this: that if something does happen in the market, I would rather my money be in multifamily or some form of real estate before I would want it in the stock market or mutual funds or bonds or anything like that. I know that when my money is safe in these types of multifamily assets.
Yep. No, I agree wholeheartedly. So I want to ask you about the development side of the business. I know you guys are buying existing value add type properties, but being that there's such a shortage of supply and this ever increasing demand, have you guys actually considered developing new from the ground up?
We have thought about it, but right now, we are not in a position to do that because all of our investors are wanting cash flow day one when we close, and that's what we would like as well. Now, that's not to say that we might not get into it in the future. We've definitely considered it, and we've talked to a couple of developers that are in the space, and it's hard right now. And that's one of the reasons why there is a supply issue is because supplies, if you will, materials are so expensive right now. It's hard to make the numbers work. Yeah. And so, even with the National Housing, the Multifamily Housing, Council, they are actually working with some governmental agencies to try to get some grants and some things together. And they're already doing that, but, getting some tax credits and things like that will motivate some investors to really want to, put their money into some more of these longer term, 15-year developmental, affordable housing projects to allow us to increase that supply. But right now, we're focused primarily on the cash flowing existing builds right now.
Got it. Just to give a general idea to the listeners that maybe are considering getting into multifamily, give us a high level point of view of how many deals you guys look at let's say on a monthly basis. And that's probably a good gauge to use. On a monthly basis, how many deals come flowing into your organization? And out of those deals, how many do you actually spend any time on underwriting and actually writing an LOI on? Can you give me a general number, what that looks like? Because I know you got to look through a lot. Right. We do personally in our business. We look at a lot of opportunities and write, a good amount of LOIs, but literally for us, it's probably like maybe about 20% that we actually spend the time to actually write an offer on, maybe not even that high. And then ultimately out of that 20%, we probably win about half of those. But what's that look like in your business?
So, I mean, the initial deal flow for us is always emails that come in from brokers that say, "Hey, we got this new listing," right? And I'm sure it's probably similar to you. Get a few off market, a few little pocket listings here and there, but for the most part, we're getting a lot of the email flow, and so we're probably getting between about 75 and 100 in the various markets that we're watching every single month.
Yeah.
And so we're not underwriting every single one of those because we have very strict criteria on what we're looking for. And so if it doesn't fit our criteria, we immediately hit the delete button. So we don't even look at it any further. We don't want to waste our time with it. And so of the deals that come through our desk, we will fully underwrite the ones that we look at on a superficial level and go, yeah, I think this could work. From our knowledge of the market and what we're seeing, we can do that. And so we'll do first an initial underwriting of the project to see, is this feasible from a surface level view? Yep. If it is, then we move forward into doing some of the due diligence on site before we submit the LOI. And we only submit an LOI each month, probably on about 3 to 5 offers a month. Mm-hmm. And it's because we're very strict. We want to make sure that we don't want to waste our time doing a lot of extra bids and extra deals and stuff like that. So we're putting about 3 to 5 a month on, and our goal for 2019 is to do $100 million in acquisitions. And we're going to be doing that by, making sure that we have minimum 10 million, and that we're doing about 1 to 2, sometimes 3 deals in every quarter.
Yeah, no, I love it. Those are great goals, man. So it sounds like you guys are well on track in 2019 to make that happen. So, congrats on your success that you've had thus far, because you've only been in the space for only a short few years. And kind of leads me to my next question. I mean, just knowing what you know today, the experience that you have, the number of deals that you've conducted, if you could go back in time a couple years back and give yourself some advice right when you're stepping into the space, what would that advice be? And it can't be buy bigger or buy faster. Those two are always used. So you can't give me those as answers.
Yeah. I think what I would probably say is raising more money from more deals. I mean, because I think from what if I look back at what I did and I raised money for various deals and I did some of my own deals, actually, now that I think about it, I'd probably say raising money for more deals, but alongside that same thing is start looking for investors sooner. Yeah. Because a lot of times we get into this phase of let's underwrite the deals, let's get a deal. And once we have a deal, then we'll find investors.
Yeah, that's tough.
No. You need to be finding the investors first, and then getting them there. And then I encourage everybody to get a mentor, because with my group that I started called the Multifamily Investor Nation, one of the most frustrating things for me is I also, because of my own net worth and liquidity, I also do some non-recourse loan guarantor and balance sheet work. And so one of the things I've found is that a lot of people in this space don't really understand how to work with investors. Mm-hmm. They're due dates are all flexible, and they're we're going to close sometime in the month of February or March, and it's like how can an investor really work with that? I'm not going to present a deal to an investor unless I know exactly when things are going to happen.
Yeah,
that doesn't mean that things can't change, but to be able to say February or March, I'm just pick a date, pick a week, you're gonna so they know what to expect. And if it changes, I mean, people understand that lenders delay things and things happen, and so as long as there's a story behind it, just communicate it with them. Mm-hmm. So being able to have, I did a presentation at our summit this past January. We did a summit called the Multifamily Investor Nation Summit. Had over 500 investors there, and doing another one coming up in June. But one of the topics that I did was a keynote that was called the mindset of a high net worth investor. And the mindset of a high net worth investor really has to go, it all boils down to being able to make sure that you communicate with them. Because when they feel like they're not being communicated with, that's when they start to lose hope, not only in you. And you might go, well, they're already in the deal, they can't do anything. Yes, they can. They can not visit you and not invest with you on the next deal.
Sure, absolutely.
That's actually worse than them not wanting to stay in the deal. I don't want an investor in our deal if they don't want to be in the deal.
Yep.
So I want to make sure that they're in our deal and that they want to stay in our deal. And if your listeners want a copy of that keynote, I'd be glad to give it to them. This is kind of just all off the cuff. So they have to email me. Just shoot me over an email at dan@multifamilyinvestornation.com, and I'd be glad to shoot them over a copy of the link to that interview, or not interview, but that keynote.
Yeah, that'd be awesome. I appreciate that, Dan. And you shared a lot of great information here today, and I appreciate you coming on the show. And what I'd like to ask of you is, as we wrap things up here, if you had just one final gold nugget of advice or wisdom that you could leave with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
I would say, kind of going back to what I said earlier on, is that, it's the same thing in my medical practices. Even though I stepped away, I was still putting things into place to make sure that I could be measuring things. And so making sure that you can put some things in place to make sure you measure not only the assets and the performance of your assets, but also your goals. Set out a goal. And I'm not that big of a goal person. I set goals, like I told you earlier, about opening up those 5 clinics in 24 months and then doing it in 18 months. But did I sit down and write them all down and do all that kind of stuff? I didn't. I just knew inside of me, I was like, I'm going to do this. This is what I'm going to do. And, but I have to be able to make sure that I'm measuring those things as well. And so if you can't measure it, you can't manage it. And so whatever you're doing in life, whether it be personal, life things, fitness goals, spiritual goals, or whether it be in business or in these real estate assets, you've got to make sure that you put things in place that you can measure things so you can manage it to make sure that that's actually performing the way you're wanting it to perform.
Yeah, no, that's great advice. Absolutely. And Dan, this has been a lot of fun. I really appreciate you coming on the show here. And I know that there's multiple different ways that we can get in contact with you. You obviously gave out your email address, but can you give our listeners an idea of what are the best sites to actually find out more about you and your company and what you guys have going on? What are the best sites to visit you at?
Sure. Yeah. So if you're interested in investing with us and you want to jump on a phone call with me, I'll be glad to jump on a one-on-one call with you and discuss your goals and make sure it's a good fit with ours. Because like I said, I never wanted an investor to be investing with us if our goals don't align up. And so you can go visit us at passiveinvesting.com. Very easy website to go to. There's a form on there you can fill out. And my assistant will reach out to you and we'll schedule a phone call to have a one-on-one and see if you'd be interested in coming on some of our future projects. And then for those of you who are interested in learning more about multifamily and possibly doing some syndications yourself, we do free weekly webinars. You can go to multifamilyinvestornation.com, sign up for our free email there, and you can also sign up there and find links to our YouTube channel. We also have our closed Facebook group, and also meetup groups across the country. We have 50 different chapters right now all across the country, over 4,000 members.
Wow, that's incredible. Congrats on that. How do you manage that?
Hey, man, I told you I'm a good delegator.
Yeah. Fantastic. Well, that's awesome. So I'm assuming one in every state. Is that kind of the plan or is it not that?
Well, I do want to have one in every state, but we don't have that now.
Okay. Well, fantastic. Well, Dan, this has been an absolute pleasure. Really appreciate you coming to the show. And folks, please go visit him at the 2 different websites. I'll put that in the show notes as well. And I'll also put a link to Dan's email address that you can reach out to him for that keynote speech that he recently had on his investor summit. So Dan, pleasure having you. Appreciate it, my friend. And look forward to staying in touch with you. Okay.
You too, Kevin. Thank you for having me.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.